Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
As we make our way through the thick of this earnings season, there might be a little bit of a reassuring picture emerging for the second quarter. Let's check in with our research director, Shiraz Mian, who maybe has more on that. He's with me here now. So we're talking here on July the 30th. Earlier this week, you wrote that the technology sector has lent some stability to the earnings growth picture, and now that has taken Q2 out of negative territory. Are you still standing by that?
For the most part, yes. So on the day when I wrote that piece, the blended growth rate for Q2 had just barely crossed into positive territory. And a big reason for that was the technology sector. And the technology sector, as we all know, is the biggest contributor to earnings in the S&P 500. In fact, technology and finance, when combined, bring in close to 45–46% of the index's total earnings. So any positive growth evidence from these two areas has an outsized impact on the aggregate growth. So it's not that we were expecting a decline before and now it's all hunky-dory and we have a ton of growth. It's just not as bad as the pre-earning season growth picture showed, and also some of the whispered expectations that perhaps these companies would come out and guide excessively lower for Q3 and beyond. So relative to those expectations, it's reassuring.
Well, now that you mention that, let's dial back to our last conversation.
Okay.
Yeah, it was originally expected that the global trade tariff situation would have had a particularly negative impact in the technology sector. Was that not the case?
That is the case, yes. In fact, not just in the technology sector, though technology is one of the more international of the businesses, but it's across the board. In fact, it came as somewhat of a surprise to many of us that even companies like JP Morgan and Citigroup, when they were explaining why the corporate and business loan portfolios were not growing as much as many had expected, cited uncertainty related to trade and tariffs as a reason for why that is the case. But across the board, Caterpillar had specifically mentioned it. In fact, CSX Corp, the railroad operator, mentioned it. So yes, that was expected to be an across-the-board an issue for technology and other areas, and that has turned out to be the case.
All right. We've already seen a weak batch of results that has helped to set a downbeat tone for the stock market. Are analysts, by chance, pricing in a longer drawn-out trade war into their estimates?
No, they are not, actually. So the expectations for 2019 as a whole were always kind of subpar. There wasn't much growth expected. But the reason for that was primarily because of the tough comparisons to 2018 when we had this outsized growth. For 2020, if it turns out to be this long drawn type of scenario that you are alluding to, the expectation is for a 10+% growth next year.
Oh, wow.
So analysts are not factoring in a long drawn out trade uncertainty. In whatever negative revision we have seen that is specifically attributable to trade is because companies have specifically guided to that effect. So like some of the companies I mentioned, Caterpillar, CSX, and many others, specifically mentioned trade and tariff issues in giving subdued guidance. And it's only to that extent that estimates. So if we do get, if this issue lingers on much longer than everyone is factoring in, that remains a downside risk to not only sentiment but actually estimates.
Okay. So let's go beyond the technology space, looking at other sectors and the big picture on your scorecard.
Sure. Yeah. So I have this slide where, as folks can see, 262 S&P 500 companies have reported as of this morning. By the way, this 262 accounts for almost 64% of the index's total market capitalization, so a fairly representative sample. And as you could see, earnings are up 3.2%, revenues are up 5.2%, 77.6% are beating EPS, 56.3% are beating revenue. And in this chart, what we are showing is on the left side, we are comparing the earnings and revenue growth rate in Q2 thus far to what we had seen from the same group of companies in earlier periods. So we compared it to the March quarter, and then we compared it to a 4-quarter and 12-quarter average. And we do the same on the positive surprise front too. So growth we knew all along would be challenged, and we see more confirmation of that. In terms of surprises, earnings surprises, earnings beats are about in line with the historical trend. 76.6% is the number tracking for Q2 now. The 12-quarter average is about 75%, so right around that level. Revenue surprises are on the weak side. So 56.3% are beating revenues in Q2 thus far. The 12-quarter average is close to 65%. So that's the lay of the land for the Q2 earnings season thus far.
All right, if you had to put a name on what sector is providing the biggest drag so far on corporate profits, what would that be?
It'll be technology. So technology before the start of this earnings season was expected to have a 10-11% year-over-year decline in earnings, and a big reason for why technology was such a weak growth picture was because the semiconductor industry, which alone accounts for almost a sixth of the sector's total earnings, is going through a very rough cyclical patch. And on top of that cyclical patch, you have these trade and tariff issues. On top of that, this Chinese tech company, the Huawei, the telecom company, a number of players are connected directly and indirectly to that company as well. So we have Apple reporting results today. Apple is also, since it's such a big player in the technology space, is expected to have 15-16% lower earnings in Q2 from the same period last year. So if we have, at the end of the day, the tech picture is notably better than what was expected pre-season, that would be the biggest difference relative to preseason expectations. That has been the case thus far, but I'm referring to when all is said and done.
Yeah.
If we have, in fact, if you exclude technology from the S&P 500, the rest of the index is about flat.
Okay.
So
let's stick with that when all is said and done scenario.
Okay.
When all is said and done, getting back to my lead-in about that, maybe that potential reassuring picture that you wrote about, are we likely to see earnings growth for Q2?
It's possible. So right now, the expectation is that the aggregate earnings growth, when you combine the companies that have reported with estimates for the still to come, is about 0.8% decline for Q2. My sense is that as the second half of this earnings season unfolds, we will perhaps cross over into positive territory. Barely positive, but yeah, I think it's fair to assume that we will not be negative when all is said and done.
And has the picture changed for Qs 3 and 4?
Yes, it has, and I have a slide that I want to share with folks. This is the picture for Q3, and what we are showing here is that the current expectation is for an almost 3% decline for Q3, and as you could see in mid-June, it was a 1% decline. So estimates for Q3 are steadily coming down. And here's the big picture. So the 4 quarters that have been highlighted here represent the 4 quarters of 2019. And as you could see, Q1 was barely negative, down 0.1%. Q2, as I mentioned earlier, is currently at 0.8% decline, but my sense is we would be either flatlined or modestly in positive area. And then Q3 is negative, Q4 is currently positive. So 2019 as a whole is essentially a washout. At best, we remain flat from the 2018 level. And as I was mentioning earlier in response to your question about long-lasting or drawn-out trade and tariff issue, the first quarter of 2020, we have growth resuming and then accelerating through the remainder of the year. And for the full year, the expectation is for an almost 10.5% growth in 2020.
Well, when I saw those words reassuring picture in your commentary this week, I was actually kind of happy.
Oh, good. No, you should be happy.
Now, not so much. Don't forget, you can always keep track of what's going on with earnings season when you dial into Zacks.com on your computer, on the internet, or on your phone, and check out Earnings Outlook in written form. Every Monday and Thursday, Shiraz publishes new written commentaries on what to expect for the coming week and what's been going on in the season trend-wise, and how that picture, as we discuss here, might have changed, gotten better, gotten worse. View it all on the homepage at Zacks.com. With Shiraz, I'm Terry Ruffalo.